Welcome to the Krinzman Property Playbook, where we dive deep into the heart of South Florida's real estate scene. I'm your host, Matthew Krinzman, here to guide you through the strategies, insights, and community connections that make buying and selling real estate a science. If you're looking to move beyond the basics, build trusted relationships, and grow your understanding of this competitive market, you're in the right place. Every episode, I'll be bringing on local pros, from attorneys to contractors, to give you the inside scoop on what it really takes to succeed in real estate. So whether you're an investor, buyer, or just curious about the market, let's kick things off and get you one step closer to your real estate goals. Welcome to the Playbook. Welcome, everyone. My name is Matthew Krinzman. I am the host of the Krinzman Property Playbook. I am a broker associate here in South Florida for the last 26 years. I am with a small little operation called One Sotheby's International Realty. We're an affiliate of the Sotheby's Realty International brand. I've been, like I said, 26 years. I'm a lifelong resident of South Florida, and my podcast is to really educate and help my listener, my watchers, my listeners, my sellers, my buyers, my previous clients, my sphere, navigate the real estate field and, how to better invest, or, how to deploy their money, or how to get out of properties, and how to, build wealth is what we're looking to do. And today I have Jeff Chisum. Jeff, you are a mortgage broker, correct? Is that the right definition for you?
I am a loan officer.
Okay.
Yes, with the FDIC insured bank. Yeah.
Okay. So, what's the name of the bank?
Northpointe Bank. I've been originating since 2008, so been doing it for a minute.
You got in right at the right time.
Yeah, that's exactly
2008
right.
When that was a time. Oh man.
Well, I call myself a survivor, and it's the things that don't kill you make you better. And that's definitely a prime example. I was definitely a better loan officer on the other side because I had seen the worst of the worst. So
right. Well, look, if you can survive this business, and especially 08, I've been in business 10 years longer than you. So I started in the late 90s when it was a pretty stagnant, normal market, we'll call it. Then the early 2000s came about and things started to take off. And then we got 2008 because what happened in the early 2000s when lenders were, out of control. Is that the word I want to look for? They were making loans that he shouldn't have been making on people who shouldn't be not necessarily owning property, but shouldn't have had 120% loan to value deals or something like that. And that's where we got to in 2008. But if you came in 2008, heck of a time to really, learn the business, right? What was your background before that? What were you doing before you got to the mortgage or origination business?
Yeah, I was in different sales roles, and was in a group where there was a sales manager for City Mortgage, and just visiting with them, and it's like, hey, you have any experience originating mortgages? And I said, well, I have one. Does that count? Yeah, but I started out in a call center, consumer direct with City Mortgage, which did that for 3.5 years. It was a grind. Managers walking up and down the aisle, making sure you're on the phone, but couldn't have been a better environment for a new loan officer because City Mortgage was at the forefront of the new regulations, and you couldn't say this, you had to say this, you had to disclose just all the new disclosures. Right. But then also I could stand up in a room when I had a question, and I had literally a couple hundred people around me to ask. So wasn't the most fun environment, but for a developing loan officer, it was a great environment.
It's a great way to learn, right?
In hindsight, yeah, that's right. Yeah. You're not just a guy on an island, trying to survive. You got people around you, which was very important when I was setting up the foundation for just knowledge and experience. Right.
So you started City Mortgage basically just on the phones. Then what's the transition from there to what you're doing now?
Yeah, so then had the opportunity to go to Chase retail. Okay. So I was working in a branch, pretty affluent areas. So we were working with people that were buying primary residences. And then it came to a point where I realized that the big banks had some challenges when it came to doing mortgages.
That's for sure.
That it is a different beast, and
Yeah.
you've got to be really good at all the ins and outs, the minutia of originating a loan and the timing of it. Can't just take all the time that you want to in the world to
100%.
get a loan closed. So came home and told my wife, if I want a career in this business, I really have to align myself with a company that just does mortgages, that understands, what it takes to get deals done. And so that started my path down independent mortgage banking.
Okay.
And self-sourcing my own business, realtor relationships. And then what that has developed into is, 100% of my business these days is short-term rental financing. And that's really been a model around kind of back to my consumer direct days, where I was going directly to the consumer. And really where I've achieved that is just education, getting
Right.
out and just educating people with the right information and making those connections that way. So that's been, and that's really been at the heart of what I've been doing all along, which is educating people with the right information, the correct information, and then just always doing the right things, making sure that we were doing what was in the best interest of our clients.
Right.
Not driven by, a certain product that maybe we got paid more on or that our company was pushing. So,
oh yeah, I've heard those stories. Yeah.
Yeah.
How that goes. Yeah.
They do exist. And,
Yeah.
I have gotten pushback, from, different sources, but, it's done well. Since 2018, I've been a top 1% loan originator in the US. And,
Wow.
Some simple principles: always be good at communication and always do the right thing. Be an expert.
I love what you just said there. Communication. That is, this is something I think in our business, the real estate business, that where there's sometimes there's a disconnect. At least I find, at least with certain, other agents or mortgage brokers or real estate attorneys or escrow people, it's the gamut, right, of our business. And I mean, it's hard enough to deal with when we have to deal with the clients, the buyers and the sellers, our customers, keeping them in, communication with them. But we rely on everyone down line to have communicate, let us know what's going on. That's really the simple thing. Hey, what's going on? Just let us know. I've had times, I mean, this happens over time where I tend to keep doing business with people that I've done business with over the years because they've delivered on service and communication. And, we're not trying to, especially on a purchase, and it's a buyer and whatever it is, it's nerve wracking already for them, and they're not getting answers and I'm not getting answers. It's tough. And that's really where having good communication, I have a skill set of communication. It's something that I don't think it's being taught or being learned by people in our business. I think it's sometimes just, how it is. People get thrown into the business and here, go to work, but they don't get trained. And I think, so either you learn or you get trained or you get coaching, one to be better at what you do. And I also like what you said, being an expert, because you're handling a big purchase, a big commitment by the buyer, and they relying on you, they're relying on me, they're relying on the inspector to really be the expert at what they're doing. And it's tough to find those experts, the person who communicates and educates their buyers and sellers, and along the way, so they know what they're doing. It's a lot of hand holding that we're doing here.
Well, and what I've developed and identified a long time ago is if you can have proactive communication, then you eliminate the challenges that come along with good communication, because
100%.
That's usually reactive or responding, or someone's having to reach out to you. But if you can always let people know what the next steps are, you can always, reach out with the update. Then from there, it's, making sure that people know what the lanes of communication are if they need to reach out to you, which, these days it's a little bit easier because, we have systems set up for text messaging,
absolutely,
email, and then, my team does receive incoming phone calls, but for the most part, we try to schedule those because, we're working with really busy people that understand the value of scheduling. So instead of, hey, just give me a call, it's tap on this link, grab a time,
right?
And we'll meet at that designated time instead of going back and forth, because I know you don't have time for that. And we don't run a call center because we're busy. We're very successful at what we do. And I don't know about you, I'd rather go see the very successful orthopedic surgeon than the one that's waiting for his next job.
Wow. Yeah. You don't want that orthopedic guy. Yeah. That's it. You don't want that professional. You're right. Yeah. You make a good point about that. You want the person or the persons who are the professionals. They know what they're doing. They are constantly working to improve themselves, their business, and also working hard for the customers and the clients and anticipating and also growing. I mean, really doing it so well where the clients and the customers are saying, hey, you got to call Jeff. Jeff took care of me. Jeff did everything. I felt it, the stress was the relief that he took the stress off of what I was doing, the purchase, the loan, getting the loan. And I think it also goes for the real estate agents who you work with. If you make our lives easier too, where we're going to keep on, you know what, Jeff, he really did right by my customer. He did right by me. I wasn't stressed. I wasn't stressing because the client was stressing. Then I had to put the stress on Jeff. That's how it works for us, right? It's like the last thing you want to do is, I found is like the last thing is I want to just keep on bugging someone about what's going on. And if you, like you said, if you can anticipate that, or you have the schedules, or you have the systems in place, then it's not a problem. You're going to be fine. Everyone's going to get done.
Yeah, and it's amazing when you have a proactive communication system for everyone involved in the transaction. So, we send out updates to the buyer's agent, the listing agent, title company. So it's that whole idea of how do we keep from them sending us information? Because when they send in a request, then we have to respond to it. They have to take their time to do it.
Right.
Someone's probably tapping them on the shoulder. What's going on here? So again, if we can have that proactive communication, then it's going to, help everyone.
Oh, yeah. Yeah. Absolutely.
And everyone's got to be involved in the process, but the loan is kind of the driving. Once it's under contract, that's kind of the driving force between getting to the finish line. You
have dates. The contract has dates. It has time constraints, and things have to be done by a certain time. And it's like day 22, and everything is due on day 22, and you still don't know what's going on. You're like, oh God, it's the worst stress. But again, it's working. You find the people you like to work with that you're not going to, on day 22, hey, the commitment's there. We're done. We're good to go. We're going to close. I've had times where I've had to chase down people, and it's not enjoyable whatsoever to do. But let's get back to what you do. So you specialize in short-term rental loans. Is that what your specialty is? You actually call yourself the short-term, your site's called the short-term STR home financing, right?
Financing. That's right. Yeah.
That's the name of your
my website and the name of
your podcast. Right. So the STR Home Financing Podcast and the STR, is it strhomefinancing.com, right?
Yes.
Okay. So let's talk about that short-term rental side of the business. It's obviously down South Florida and Florida in general. It's a huge business. Mm-hmm. There's a lot of investors. We got the Airbnb guys, buying up properties, condos, houses. So let's talk about how you come in and can make that purchase possible for those investors.
Yeah. So, the majority of the clients that I'm working with are what I would call lifestyle investors.
Okay.
So they're looking for lifestyle assets. So they're not the, professional investors. Some of them are that, this is their sole source of income. This is their business that they're going and building this portfolio, and short-term rental income is their sole source of income. So, with that, if this is 100% of my business, 90% of my clients are using the 10% down second home occupancy loan, because, the number one piece of criteria for that loan product is that, and it is this general, that your intention is that you're going to occupy that property at some point during that first year. So it's not a specified amount of days. It's not a percentage of the year that you're having to meet. So, with that, these are people that are going to be enjoying these properties. They're going to be going down to South Florida 2 or 3 times a year to go stay in it. And then the rest of the time, they're going to rent it out on Airbnb.
Right.
So it's going to be, instead of a lifestyle liability, which is what a true vacation home is in my mind, some people can, buy a property like that. They're going to occupy it two or 3 times a year, and then it does stay empty, and they're just paying bills on it. So these lifestyle assets, they're going to pay for themselves, and a lot of times they're going to generate cash flow as well. But yeah, by far, the 10% down second home occupancy, because of that lower down payment requirement, and it's going to have the lower of the interest rates out of any of the products for residential outside of a primary residence, makes it the most utilized products in this space. So I have people all the time that tell me, Jeff, wish I would have run into you, a few years ago. And if I wouldn't have had to put down 20%, or I could have done something a lot sooner knowing that I only needed 10% down. So it's been a great opportunity to educate people.
Now, the 10% down, now, is that a specific type of real estate? Does it have a single family, townhome, condo? What is the criteria for that you'll allow the 10%?
Yeah, great question. So it's got to be single family, one unit. So it can't be, multifamily. It's got to be a 1 unit single family home or townhome. A lot of condos don't qualify for this product because it's typically not going to be approved by Fannie or Freddie.
Right.
Because in destination areas, they're typically going to be occupied as people's second home, and Fannie really only will do that product in developments where the majority of the units are occupied as primary residences.
Okay, got it. Yeah, that makes sense. Also, I mean, I would, in South Florida, we have enough issues with the condos where, we have to meet reserve requirements, what the rental ratio is to the ownership ratio. I guess what you call it a streamlined questionnaire type of deals, and the 10% is not a streamlined questionnaire. That's the full condo questionnaire at that point. And so I get that why it wouldn't be available on the condo. Even just as a primary residence right now, condos are tough.
Yeah, it's a little bit more challenging of a process, and you definitely want to know someone who's been down that road, knows what they're doing. But we do have a 15% down option for condos on second home occupancy that is a portfolio product to the bank.
Okay.
So, that is a good opportunity. A lot of times, the less you can put down, the more comfortable it's going to be. Yeah.
Yeah. Because you free up your cash for something else, or you free it up to make an improvement on the property that you may not. If you put 20, 25% down, even 30%, you may not have that cash now to make the improvements you want. So but obviously on a single family or a townhome, now the townhome, it should be fee simple. Would it need to be a fee simple townhome community?
As long as it is classified as a townhome, it's considered a townhome. That's the important thing with Fannie and Freddie from that standpoint. And, you probably could speak to this better than I could, but, you've got to make sure that your search criteria is dialed in with that townhome chosen, because, you can look at just property listings, think something is a condo just from appearances, and it ends up that it's a townhome. So that's one thing that I would mention there is you want to make sure that you're dialed in properly on your property search.
Right. And so sometimes I've heard if it's a second home purchase and they're getting a loan, a lot of times the lenders will have, or the banks or Fannie, I don't know if it's a Fannie Mae or Freddie Mac criteria, but they have it has to be a certain distance from their primary home. Is that true, or is that just something that I've heard and I may have misheard?
No, you may have heard it. It's just outdated information.
Great. Yeah.
Yeah, the Fannie and Freddie has no distance requirement. It just has to make sense. So, in your area, you may have someone that lives in a traditional subdivided neighborhood.
Yeah.
And then there's a beach area that they like to go to that's 20 miles away.
Mhm.
They want to buy something there because, they don't like the having to go back and forth. Hey, let's just own something. So if we want to go spend a weekend or 3-4 days, we don't have to worry about going back and forth. So that is a great example of where that would make sense, that someone would be buying something with that second home occupancy loan that's relatively close to their primary residence. So that's a great question, a typical scenario.
Now, when the lender is doing a deal like that on a 10% down second home loan, as far as the profile of the borrower, what are they looking at on that in those cases? Because I know obviously what they're looking at in the primary, but what are they looking on the secondary?
Yeah, and just to back up one step real quick, Matthew, because you may have some of your audience that does run into that distance requirement.
Yes.
So there's two things that may be possible. One is that they have just outdated information. They aren't up to date with the most recent information, which isn't uncommon because most loan officers' primary business is going to be helping people with their primary residence.
Right.
So they don't get into the second home product a lot. And so that's where they just may not be up to date on the information. The other one may be overlays. So there may be, they are originating for a bank or they're originating for a non-Fannie or Freddie investor that does have a mileage requirement.
Okay.
So you may get a different answer there as well. But 90% of my clients using the 10% down second home occupancy loan are typically going to be W-2 wage earners, because Fannie and Freddie, love that W-2 income.
They don't like us. They don't like us 1099s.
Yeah, that's right. They love W-2 income, which is the majority of, the population in the United States, and, is reflected in my mix of business. But, the big deal about the second home occupancy loan is you have to have the capacity within your debt to income ratio to absorb that payment for the property and not be able to consider any income that the property might be generating. So that's going to be different from like an investment property loan, where you can consider that projected income into your ratios. The second home occupancy loan, you cannot. So beyond that, it's the normal things, credit worthiness,
ability to repay.
The ability to repay. That's exactly right.
So now you mentioned investors or loans where they're looking at the cash flow of the property. So this takes us into, what's it called? A DSCR loan? Is that what it is? So what's the acronym stand for? Just for the people who don't know what it means.
Yeah, so that's debt service coverage ratio loans. So what we're looking at there is, we're not looking at your personal ability to repay the loan like on a Fannie and Freddie loan.
Right.
The approval is going to be based on the property's performance to repay the loan. So what we're looking at there in the short-term rental world is data that would show that the gross income on a monthly basis, the projected gross monthly income, is going to match the principal, interest, taxes, and insurance payment. So that's the 1-to-1 ratio. Gross income is going to equal principal, interest, taxes, and insurance. So beyond that, you still have to have an acceptable credit score, which generally is going to be 680 or higher.
Okay, that's not crazy.
Yeah, not crazy. You've got to have 6 months in reserves for the property for principal, interest, taxes, and insurance payment. And then your down payment requirement is going to be based on your experience. So if you're an experienced investor with some compensating factors like high credit scores, you've got beyond the 6 months in reserves.
Right.
We're well beyond that 1-to-1 ratio. There's a potential that you only have to put 15% down on that DSCR product. If you don't have those compensating factors, you need to be prepared, but you are an experienced investor, so that would be someone that's owned a cash flow producing property for 12 months in the past 12 months, which there can be exceptions there as well, but you have some landlord experience.
Okay. So your track record.
You have a track record of, owning, something other than a primary residence, then 20% down is a down payment requirement there. And then if you're a new investor, you can still do a DSCR loan. You just need to be prepared to put down 25%.
Okay. All right. And so when they're looking at the income, are they looking at the income of the property that the investor's looking to buy, or are they just have this? They just look at like, hey, this is what the rental rates are in this area. This is what we're going by. This is what or are they looking at a pro forma that's been given to them?
Yeah, if it's an existing short-term rental, which it doesn't have to be, but if it is an existing short-term rental, we can use data from the seller. So, typically at least 12 months of records to show the cash flow. If we don't have that, then we order rental comps with the appraiser, which a lot of times what we're seeing in short-term rental markets is they just don't have enough data for long-term rentals. So they are supplying short-term rental data. If we don't get that, we don't get what we need there, then we can use data through a platform called AirDNA. AirDNA is
familiar with it.
Yeah, nothing but short-term rental data. So that's nice because we have access to that information up front, because that's the other question that we get is, how do you get pre-approved for a DSCR loan if you're not using my ability to qualify? It's based on the property. So in that case, we pull credit, we verify, your experience, your reserves, and then we can look at the market data up front based on, the area, bedroom count, bathroom count, occupancy, to let you know if it looks favorable to get an approval in that area. And then from there, you're ready to go. You've got the 20% ability to put 20% down, 6 months of reserve. Here's your letter. Not bad. And now what about, is there anything as far as 100% financing available on these short-term rentals, or is that pie in the sky? Well, it's a strategy. So there's not a product that you could do zero down, 100% financing. But there is a strategy to leverage a HELOC on other real estate that you have to fund your down payment and closing cost. So in other words, an acceptable source of funds for whether it's a DSCR loan or a 10% down second home occupancy loans are funds from a HELOC. So I thought. One of the episodes that I do, and it was an earlier one in my podcast, it's called Creating Your Own Down Payment Bank. Right. So we're not looking to, fund the entire purchase from that HELOC that's secured against maybe our primary residence and, potentially over leveraging yourself. But, to fund a 10% down payment and 3% for closing cost, you're not extending yourself too far out there. And then you're putting on, the numbers should show on that acquired property that it could perform at a level to repay that debt on the HELOC and it not depend on your W-2 income, your personal finances to repay it back. So that's kind of a summary of that 100% financing strategy. Got it. Okay. Yeah, I've heard that, done on primary, back sometimes what they'll do is, if depending on if there's enough equity in the deal where they can do, say, I don't know, it's like 80%, LTV, then I can do a 10% because you're not going to get 100%. It's hard to get 100%, but especially on a primary, but they'll do a 10% second or a wrap around it, to do that. I've done those. I've been a part of those in the past. I don't see that as often now, but a while back ago, that was a pretty popular way of getting someone to close to 100% or 90% down, 90% LTV to do a deal. But yeah, it's interesting what you said. I figure it was going to be, you're going to do a HELOC on your primary. Can you now, let's say I own short-term rentals. I want to build my portfolio. How best to build that through the financing or the leveraging? Yeah, no, great question. And I tell clients all the time on a daily basis, we are not looking to do a deal where we're looking to build a relationship, because our clients typically want to build a portfolio of these lifestyle assets. I had a guy a couple of years ago. It's funny, you and I were talking about the weather before we came on, and I had a client a couple of years ago that said, Jeff, my philosophy for building my portfolio is pretty simple. The older I get, I just want to be able to chase 72 degrees year round. And I was like,
that's San Diego then.
Yeah, well, and that's brilliant, to be able to have these different properties around the country. And, you want to go skiing, you got a place in the mountains, you want to go to the beach, you can go to South Florida, whatever the case may be. But yeah, so typically what we're going to look at is exhausting that 10% down lane as far as you can possibly go, which, the two typical restrictions there are going to be the number of mortgages that you have in your name. So Fannie and Freddie will only allow you to have 10 mortgages in your name. Now, there's nothing to say that all 10 of those weren't originated as the second home occupancy loan. So you could have 10 of those second home occupancy loans in your name, use it 10 times. So that's the other thing that I get, the question I get is, can I use this more than once? Absolutely. You could use it up to 10 times if you wanted to. Or we exhaust that debt to income ratio lane. So you bump up against that debt to income ratio ceiling. So from there, you either slow down to where you can start reporting that income on your tax returns and use that towards qualifying, which the important thing to know there is you only need a 1-year history of that under Schedule E to be able to use it. Schedule C, if you ran it through a Schedule C LLC.
That was a question I was going to ask. Thank you.
Yeah, you would need 2 years, but if you run it through Schedule E, you only need 1 year.
Okay.
So there's potential that you could, slow down a little bit, claim that income, and then, stay in that 10% lane. Or you may want to scale faster, and that puts you in that DSCR lane where you just need that ability to put the 20%
down payment. Yeah.
But, otherwise, you're not restricted by your own personal ability to qualify. So that's kind of a common path that people go through.
So how long have you been strictly doing short-term rental lending? Or is your niche or your specialty? What's your
5 years now.
5 years now. Okay, great.
Yeah.
So you've seen what the market is and what the trends are in the short term. Where do you see the financing going forward? Going now forward, because we see a lot of short-term rental properties here, and we see some of them starting to come back to the market, as because the operators maybe just have not succeeded in where their numbers are, or they're trying to offload. But where are you seeing your side of the business going, as far as the future or present and future?
Yeah, so I'll use DSCR lending for an example. We were in the double digits as far as interest rates go about this time last year.
Yeah.
We've dropped at least 2% since then. So, what that is telling you is there's a lot of interest from investors, because that's your hedge funds. That's going to be
your portfolio lender.
Yeah, your portfolio lenders. So there's a big appetite for doing that type of business, and it's driven the rates down. The other thing that we've seen is what they're willing to do. So we've seen the LTV, or the loan to value, down payment requirements loosen. Your ability to do cash out deals has shortened. The time frames have shortened. So the DSCR loan, we've seen, a lot of things happen there. Now, what on the flip side, back in 2023, we saw an administration that added additional fees to the 10% down loan and the investment property loan.
Oh, I remember that. Yeah.
To try to keep investors out of that space, because the answer to the housing shortage is that you had all these investors that were buying these short-term rentals and keeping people from buying primary residence. And I was like, I don't see too many first-time home buyers, buying beach houses in South Florida, or, buying places in the Smokies. So,
right.
And we've seen over the past 2 years that didn't fix, our housing shortage.
Did nothing.
So
yeah.
Now that, we've got an administration that, has been friendly towards investors, real estate investors, and understands how much of the world's or the country's economy moves around real estate moving.
100%.
I think we'll see, some better rates. these additional fees, so it'll be cheaper to do those loans. So that's what I see over the next year happening.
So if I'm a purchaser of short-term rental property, what am I looking for in the lender, or who am I looking to do business with? Obviously Jeff Chisum is one person, but what are we looking for as investors, or as buyers of these type of properties in the companies that the lenders that we're working with?
Yeah, I mean, I'm a big believer that there's value in experience.
Yes.
So, a common conversation that I get into, like I said earlier, Jeff, I wish I would have talked to you sooner before I bought my first one. I wouldn't have had to put down 20%.
Right.
What that conversation typically was looking like was they went to, their guy or, a local loan officer and said, I want to buy an investment property. And that was their first mistake, because then the loan officer was automatically locked into, okay, we're going to do an investment property loan, 20% down. And they never got around to asking the question of usage, which really looked like, okay, you live in Chicago, you're buying a place in South Florida. That sounds like a destination area. Do you guys plan on going to visit there? Well, absolutely. Yeah, we're buying a place where we can go get out of the cold weather, and we plan on going down there, at least 2 or 3 times a year. Well, with that conversation going that direction, now we're talking about the 10% down second home occupancy loan versus a 20% down investment property loan. So it's just, doing that business all the time, to ask the right questions. So you're looking for an expert, number one. The DSCR lane is really where investors can get in trouble dealing with the wrong lender. I did a few podcast episodes because I was so just bent out of shape about what I was seeing in that area as far as lending goes. Because a lot of people don't know, because it's not a fully qualifying Fannie and Freddie loan. So you don't actually have to be a licensed loan officer to originate that loan. So
that's okay.
You could be dealing with the guy that just got pulled off the streets that was selling widgets and now they're doing mortgages.
Yeah.
And they don't have a license. So, a lot of people might think that what we do is pretty simple. It's not. And
it's not.
There's just the knowledge of how to get loans done, but there's also that goes along with the licensing is the understanding that you can't just tell people things and then come back and it end up being something different. So that's where I really got upset with some of the things that I was hearing and I was hearing them, on social media. I was hearing them from clients where I was told one thing and then it ended up being something different.
Been there.
So,
yeah.
The broker world, and I'm not bad-mouthing brokers, but when you're told, hey, I'm going to go out and shop you for the best deal, that relationship with the investor is super important, because you want to know what their appetite is. You want to know what their rules are. You want somebody that's dealing with them on a regular basis. And so, we've been dealing with the same investor for the past 4 years. We know what they will do, what they won't do. We keep control of the entire process. So that's the other thing that you want to ask is, tell me about the process. Are you having to send this out to have it reviewed, or do you keep control of the process?
Is everything in-house?
Yeah, is everything in-house? That's an easy way to put it, because, you just don't want that 30-day contract period to turn into, we sent it out for a review. Where are we in the process? Well, we're waiting to hear back from the investor. That's just not a good experience or a good position to be in, because then you're, 2 days before closing in that situation.
And I'm calling you like crazy at that point. Like, what the hell's going on?
Yeah, you're like, this seller is not going to extend my.
I've been there.
Yeah, so you don't want to be in that situation where your lender does not have control of the process.
Right.
Because, like I said, it sounds like a good idea that I can go shop your deal until it turns into a situation of, well, we're waiting to hear back from the investor from their review.
Yeah, I've been there, done that. I've heard those. I've heard that myself personally. And it's no fun. So I think also is worth mentioning is working with someone who can write the loan in the state that you're looking to purchase the property. I think that's also another thing that someone that I think most buyers don't realize. That's something they don't think about, because I've obviously run across with people from other states. Oh yeah, my mortgage broker, my lender is in Maine, and they said, like, they can't. No, you're not going to be able to write the loan. You're going to have someone here or work with a lender or an originator that can write in this state of Florida, because not everyone can write. You can only either you're in the state that you're licensed in, or if you have, I guess, was it the national license, then you can write, you can be able to originate the loan in that state. But I think buyers don't always realize that, or they don't know that.
Yeah. And it's, kind of in the same lines with, working with an originator that does the second home loan every once in a while. They know it's there, but they're not familiar with all the ins and outs of it. So it's kind of the same way with doing deals in states and in multiple markets. It's got to be something that you have experience in, that's something you do on a regular basis. And so, it's not by accident that I'm with Northpointe Bank, which is an FDIC insured bank, where my license will allow me to do loans in all 50 states, but not just allows me, we do loans in all 50 states. So we're used to, all the things that you've got to make sure that are in line and in place and are going to, be the things that your clients need to know, that are state specific, county specific. Right. So you don't want the guy that just, I can do a loan anywhere. Well, do you do loans? Yeah. When's the last time that you did a loan out of state? And Never. If they say, that's exactly right. So you don't want that. You want someone that has that experience. So
it's an important thing, because I don't think, like, a lot of times you realize the buyers are just not educated. They don't know. It's not, they weren't educated by either the realtor, the real estate agent, or the lender, the loan, either mortgage broker, the banker, whoever they're dealing with, didn't educate them on that. And you can't, I'm not going to blame the buyer. Just says no. They're looking to us as the experts, as you said, for that information. And that's what we're supposed to, that's what we're doing. Like I said, I've been there. I'm like, no, here's someone you need to talk to. Here's the lender, here's the mortgage broker, here's the originator, here's the banker, whoever that's local, for especially on a primary, or something like that. But it happens enough.
Well, that's why we want to connect with the buyer's agent as soon as possible once we get someone pre-approved. Not only so we can explain, hey, we've got this pre-approval letter system that you can access 24 hours a day, 7 days a week. You're not going to have to wait for us to generate that. But then also but then also just to let them know, hey, you're not dealing with a new guy here. You're not dealing with someone that does out-of-state loans every once in a while. This is what we do.
This is your business.
This is our business. Yeah. And, I don't use it to brag, but it is important for people to know that I've been a top 1% loan originator since 2018. So
that's fantastic.
It's not something that we do it at a high level. We do it really well, and we're not messing around. We're doing things the right way, and it's important for everybody in the transaction to know that.
100%. Yeah. No, I appreciate all that you're bringing to the table. What you're telling me, what you're explaining to me, educating me on. Hopefully everyone who's going to be listening or watching this podcast, and like I said, I'm going to send this out to my sphere. Obviously, and my people. But it's educational. This is what we're doing here. We're trying to educate people so they don't make. It's not to make mistakes, but to prevent mistakes or errors, or they don't have that conversation. I wish I would have known I could have put 10% down.
Yeah. Well, and sometimes it's a matter of asking the right questions or knowing what questions to ask. And a lot of times that's what you can educate people with is, not just taking for face value that so-and-so, made this referral, but knowing to ask these questions about these referrals, because your situation and your transaction may be different than that referral source, and that person that they referred you to may not be the right fit. But so it's always just good to ask questions.
Absolutely.
And know the right questions to ask.
Okay, so So we're going to wrap it up. Where can people find you? Where can people find Jeff Chisum? Where are you promote? What do you have to promote yourself? Obviously, you mentioned your podcast. We're going to mention it again. Give us your socials. Not your social security number. We don't want that. Like your social media, the Instagram, the Facebook. If you got TikTok, if you're doing the TikTok dances while you're doing to promote mortgages, give us that. Like how people can get with you. Connect with Jeff.
Yeah, well, hopefully one thing that people have picked up about me up to this point is I'm probably not your TikTok dancer guy.
Neither am I.
But yeah, the best way to connect with me really is through my website, strhomefinancing.com. So there's a little introduction video that's like 2
I saw
minutes
that.
where
Yeah.
I just tell about, our family's journey into investing into short-term rentals, ask a few questions, and then leads to 4 5-minute videos that educate people on the products, the pre-approval process, and then the value that our team brings to the table. And really, those videos, I used to cover all that information on hour-long phone calls.
Wow.
So what I did was, I think in everybody's best interest, mine included, was, hey, let's just video that information.
Smart.
And then we'll schedule, a 15-minute phone call. So there is an opportunity to schedule a call because I do want to connect with people on the phone. I want to hear, maybe something that you feel like is unique to your situation, or just you need clarity on something. And then I love to hear about the dreams, love to hear about, what people are looking to do. And that's the thing, is I've just come across so many amazing people that are looking to do really cool things in cool areas of the United States. So it's fun to have those conversations. I love having those conversations. But yeah, that's what the website looks like. And then I think I'm up to like 60 episodes on my podcast. Yeah, it's just 10-minute bite-sized podcast where I take a subject or a topic and then present the information. Then we move on to the next one. So
awesome.
A lot of good information, strategies on my podcast, STR Home Financing, on Apple and Spotify.
And your Instagram is it Jeff _Chisum _ Mortgage Pro. Yep. And then we have you at Facebook at STR Home Financing. So
that is it.
People can find you.
They can find me. I'm there. I make it easy to find. I make it easy to communicate with me. So
that's awesome, man. I really appreciate what you do. Obviously, I'm a real estate agent, broker, and been at this a long time. And, it's not easy what you do. And I appreciate what you bring in as far as educating the buyers, as far as the short-term rentals, because actually for me, it's also very educational. Now I have more information and I understand. I'm more educated, which I love being, because I want to be a resource for even if they don't buy from me, even if it's just a friend and, hey, what do I need to do? And I'm like, oh, you know what? Here, I can tell you a little bit more, and then I got the right person to connect you with. Yeah.
And I think there's always going to be a place in the world for people that can educate and connect.
100%.
And have that heart to do it, that vision to do it.
Right. All right, Jeff, we're going to wrap it up, man. I appreciate your time. I appreciate you coming on. Like I said, I enjoyed this very much. I don't think, it's like it's someone we're obviously in real estate all day long. And then, the last thing, when I get home, I don't want to talk about real estate. But when I'm at work, this is fun for me because this is a little different. You get to meet, like I said, I get to meet people from all over the country. Like, you get to write loans from people all over the country. So, for me, this is a lot of fun to do, and to get more educated about this niche of lending that's available. And especially in my market, that's something that is important to know about, and another tool in the toolbox for me. That's it for today's episode of the Krinzman Property Playbook. I hope you've gained some valuable insights and feel inspired to take your next steps in the real estate game. If you're ready to make a move or need expert guidance, let's connect. Whether you're buying, selling, or looking to invest, I'm here to help you navigate the South Florida market with confidence. You can reach out to me directly through my website or on social media. Let's get the conversation started and make your real estate goals a reality. Thanks for tuning in, and I'll see you next time on the Krinzman Property Playbook.